So, what is the best argument in support of market efficiency? Well, basically the question here is, do money managers beat the market? Research says no. Now, it's not consistent at all, right? It's not across the board, right? There are some contrary opinions in research, right? But the fact that sectors seem to rotate within the mutual fund categories kind of repeats, tells us that, there's this constant rotation thing. So nothing is ever number one all the time. So this tells us that there is change in information and that sectors are changing. So one of the largest reasons why active managers underperform is fees, right? Active management is very expensive. So what outcomes can you expect if you just buy the index? Well, passive investing has gained a lot of popularity. The reasons, number one is it's pretty predictable, right? You can't predict how the market's going to change. Not perfectly, but better than individual companies. But also, it's a lot less expensive. Again, the tax advantages, etc., they're all very beneficial to the individual investor. So, what value then do we get from doing all of this active management? Why do people do this, right? So again, if we don't get excess returns, why do active management, right? Most analysts believe, right, that markets are fairly efficient. Managers can help investors keep on track with their goals, right? Active management gives us structure, right? In addition, managers, right, if you think about a manager being more a company, right, a company has a greater ability to be in close contact with corporations than individual investors. Think about companies like Disney that has 1.8 billion shares. There's no way the individual shareholders can keep in touch and have any kind of monitoring or control mechanism with the larger corporation. So we need this active management. So what is behavioral finance? This is a merging of the psychology investing with the investment theory, right? This has become a very significant issue lately, right? That it has created some issues, some havoc, if you will, with those money managers who are applying traditional investment theory when sometimes those theories are weakened by individual behaviors, right? So there are three kinds of, they talk to them about as being tributaries here, but basically there's psychology, there's social psychology, there's neurofinance, there's the investment. There is a collision with these three things. So we need to kind of understand what that means. So there are many biases that we can relate to, I guess. So what is a bias, right? It describes a behavior that persists longer than might be beneficial for some underlying non-investment theory reason, right? So frequently we talk about investors investing with their hearts and not their heads, right? They're not using investment theory, they're using their psychology to help them with their trades, not necessarily helping them. Sometimes it is a disadvantage to do that. So there are several of these. We're not going to talk about all of them. This is just a spattering of some of the biases, but something called the belief perseverance bias. People have a tendency to have a set of beliefs. They can't get away from them, right? So again, we kind of say, well, I bought this thing. I thought it was going to be good. I think it's going to come back. So we hold on. Overconfidence, right? This is sometimes referred to as confirmation bias. When we have a trade, when we make a trade, we tend to look for information to help support my opinions and decisions, right? I ignore any information that might tell me that my decision was incorrect. Noise traders, right? This is really is sometimes referred to as following the herd, right? When things start to move in the market, sometimes investors jump on the train. This is particularly true of the more or the less sophisticated kinds of investors. When they see movement, they jump on. Now, since the movement has already happened, that implies already they're too late. They're getting in too late. So again, most of these biases just reflect when I make a decision, it's hard for me to change that decision because of my internal psychology, right? We refer to something here as fusion investing. This kind of brings together two elements. It brings together the concepts of fundamental value and investor sentiment, right? So this talks about when investors tend to be, again, more active. When the market is rising quickly or falling, many people are trading, and the noise seems to take over. So less sophisticated investors tend to get in too late, and they leave too late. So again, these noise traders, as activity fires up, these people tend to jump in. That creates noise in the information, right? Noise is not good for us to trade on because we don't know the truth of all the noise. So what are the implications of efficient capital markets, right? We mentioned two questions earlier. Do prices move correctly with the type of investment? Research indicates this is generally correct. But how quickly does it move? For some, it moves very rapidly. For others, it might take time. The faster it moves, the harder it is for us to earn excess returns. The slower it goes, the more you can trade and at least get some of those profits. Again, this doesn't mean that you can't make a profit. It means that we cannot earn excess returns. That is, you cannot beat the stock market on average. So, fundamental analysis, right? This is really the foundation of traditional investing theory, right? Professionals tend to talk about a company's story. If it has a good story, there may be opportunities for profits. So investors are searching for that story so they can create and determine an intrinsic value. And of course, we compare that value to what it would cost to purchase that asset and then make a trading decision. So if you can do a superior job of estimating value, then you can make superior market timing decisions. So intrinsic value involves several things, obviously. It involves an aggregate market analysis. We need to understand how the markets are moving. We also need to combine that information with industry and company analysis. This is, again, the foundation of fundamental analysis, developing the story for a company. So, research shows that using only historical data may not provide opportunities to beat the market. So the weak form is efficient. You can't beat the market just using historical data. We need something else. We need other metrics, right, to help with some long-run changes possibly. So again, market analysis sometimes is just not enough. If we can employ more detailed company information, industry information, and combine that with market information, maybe we can add to that historical data that I have that can help us make better decisions moving forward for investing. So there are important relationships between expected earnings and actual earnings. So if we can accurately predict earnings surprises, that would be very beneficial to choosing good stocks. Now the strong form hypothesis implies that some managers may be able to achieve higher returns. Well, how do they do that? Right? They may have inside information. They could be doing something illegal. On the other hand, not being quite as cynical, right? If they have just better information or better tools to use, that is what could be helping them earn higher rates of return. It's not necessarily the information. It's how we use the information that gives us benefits. So in the end, conclusions about fundamental analysis, right, is, the better methods, the thing about using better methods is it's hard to keep them a secret, right? Fundamental analysis, people catch on to your strategies. It's very hard to keep a winning strategy quiet. As that information now leaks out to the public, now everybody knows it, and of course, if everybody is trading on it, eventually that information is traded away. You lose the strategy. So what if we have portfolio managers, but they don't have superior analysts, or they don't have superior skills? Well, the tricks above are kind of obvious, right? We've talked about this, the basics, right? We need to create the right portfolio. It should be globally diverse. We need to manage that portfolio, right? We need to rebalance it frequently. And then we need to minimize transactions costs. So if we don't have superior analysts to work for us, and we're doing this on our own, it begs the question about passive investing and active investing. If active management doesn't provide better results and it's more expensive, why do we do it? Right? Passive investing or management can deliver the returns you need, slightly more predictable, but it costs less and it requires much less time. So a basic strategy with behavioral finance, though, says, look, if we know how people make decisions, and people are frequently wrong in those decisions, then we should do the opposite of what everybody is doing. This is what's referred to as the contrary theory. Find a metric that tells us what investors are doing. and then do the opposite. Now, when I say investors, I'm really talking about individuals, right? We don't want to look at what money managers are doing because they are sophisticated, or certainly more sophisticated investors. So we want to try to come up with numbers that identify what the average person is doing. And there are several of those that we'll talk about later on throughout the course. So again, that's the end of this video. Hopefully you found that informative. I'll see you the next time.